company provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously and we will not distribute or sell your information to anyone.
All right, fantastic. So how is everybody today? Nice up day in the market after a nice down day in the market. So we're basically going nowhere so far. I guess on the weekly basis, where are we for the week? Here we go. SP. All right, so we started off, this is Monday, so we start off with it. Here we are Monday. We gapped up at the open, went across, went all the way up, came all the way back down to where we were on Friday, and now we're pushed back to here. Now, obviously the powers that be would like the market to be high into the election. That's how you maintain the status quo. You tell people how great everything is, and you can't tell how great everything is, people how great everything is if the market's collapsing. So, that's basically the measure that's going to drive all of Trump's decision making going forward, is how is it affecting the market. I don't even know what the hell he was doing with that, like canceling stimulus yesterday. But he reversed it pretty quickly. But it's not really reversed. I don't think he understands how government works, because you have to have the cooperation of the House of Representatives they hold the purse strings to the government. That's one of those checks and balances. And he can't make edicts to say hand out money. He said something yesterday about the money having been allocated, but it hasn't been allocated in the way he's saying. Otherwise, he would be able to do something with it. If it was officially allocated to a resource, he could repurpose it. But all that stimulus money has been sucked up in various ways. So that's what it was about. That's why he wanted that $500 billion discretionary cash, was so he could dole it out and buy votes with it in November. And they gave it to him, and it all seems to have disappeared. So we'll see what happens when they do an audit, but that's, who knows what's going to happen between now and then. Bottom line is that the market, in the big picture, we opened the year here at 3,300, and now we're at 3,400. So is the market up for the year? Yes, the market is up for the year. So that's where we are right now. Despite all the issues we've had, despite the COVID and all that, the market is up for the year. Now, obviously, you might say, well, why is the market up for the year when GDP, for example, let's see. Oh, here you go, GDP now. How nice. Oh, that's not the Atlanta Fed GDP now. How do I get to that? GDP. So here's the Oh, here we go. Okay. Quarterly. So the percentage change is supposed to be up 25% from last quarter. Of course, last quarter was a disaster, and it was down 34%. So the problem is, this is what everybody thinks is so great in the economy, that GDP's rebounded. But if we take 100 and we say it's down 34%, that would be times 0.56%, no, 66%. So that's down 34%, right? Now, if we multiply that by 25% or even 30%, let's say 1.3, now you're at 85. And this is what I was talking about. Oh, you guys can see it. I was on Bloomberg yesterday, except it's a tape for today. This is what I was talking about yesterday, and it's hard to gauge the reality of something, because that you're going to see the headlines on this GDP report that say, oh, we're up 30%. We're up 25%, whatever the number is. We're up 25%, we're up 30%. But that's from last quarter when we were down at 66. When the GDP was 66% of where it was. So coming back 30% only gets you to 85% because you're multiplying your 30. You're down 34. That's 34 out of 100 that you're down. But when you go back up, 35 or 30. It's 30 out of 66. It's not 30 out of 100 that you go back. And that leaves you net down 15-ish. So all people know, and not all people, but those people who can be fooled all of the time, as Lincoln likes to say, some of the people who can be fooled all the time, and all of the people who can be fooled some of the time will react to a headline like this, where the GDP is up 25%, 30%, and say, oh my God, what an amazing economy. All right, but what's our quarterly GDP? So we have arguably a $20 trillion economy. We divide that by 4 quarters, $5 trillion, okay? So if it was down 34%, if it was down times 0.66%, that means last quarter it was 3.3 trillion, even with all the stimulus. Let's keep that clear. After 2.2 trillion direct dollars, not counting the Fed dollars, not counting anything funny, 2.2 trillion actual dollars were borrowed by the US government and placed into the economy in the form of stimulus, etc. After that, we were at 3.3%. All right, now, not all that money got spent in the first quarter. So over 2 quarters, we have a 3.3%, and then times 1.3, if we go up 30%, plus 4.29%. So that 4.29 plus 3.3 over the 2 quarters is 7.59. That's how much GDP we had in the second and third quarter. Now, so first of all, if those are 7.59 and the GDP is usually 5 per quarter, that means for the year we're at 17.59. And that means for the year we're under 18, which means for the year the economy is down 20% from last year with all the stimulus. 10% of that is stimulus, the total economy. In these 2 quarters though, when we divide 7.59, so we say 2.2 divided by 7.59, 28% of the economy is stimulus right now. So that's why when Trump tells you he's not doing any more stimulus, the market immediately collapses. Okay, that's like taking a patient off life support. They're going to die. It's not a theory, it's a fact. If you remove the life support from a patient who's terminally ill and being kept alive by a machine, when you unplug the machine, they're going to die. That's why they have court cases about it. Is it murder or is it whatever? You know, it's like that. But the bottom line is, it's not a court case arguing over whether the person will die. And I know some people don't die, but you know, it's like a miracle. But generally, when you unplug those machines, the people die because you're keeping them alive artificially. That's what we're doing with the economy right now. We're keeping it alive artificially. We're keeping it from being down 50%. It's only down 25%. And if we hadn't done the stimulus, we'd be down close to 50%. So on that basis, what the hell are the markets so excited about? They're excited about the wrong things. They think that this number is fantastic, that we can grow the economy 30% per quarter. It's not growth, it's a bounce. So let's go back to something else. Go GDP by quarter. Images. Yikes. No shit, really? That's terrible. So there's your GDP by quarter. Yeah, that's us. So Now, the first quarter, we didn't really, I mean, we kind of, we had a little bit of a hiccup in the first quarter with the virus, but not so much until March, middle of March. So even in the first quarter, we were already slowing down. The quarterly GDP represents a change from the previous quarter. So first we're down 5, then we're down 33. That's down 38 total. It's actually worse than I was just doing the math on, because it's quarter by quarter GDP, quarter to quarter growth. So if you go -5 and then you're -33, that's -33 from the -5. So you shrunk 5% and then you shrunk 33% more after that. So if you want to actually do the math on that, it would be 100 times 0.95 times 0.66. So you're down to 62.7. So now, if we're up times 1.3, if we're up 30%, the change from last quarter is up 30%. It's only up 30% from 0.66. So we're at 81.5. So it's a bit worse than I said before. So the thing is, and we're not that much worse than the rest of the world. The whole world's a mess. We're just the worst mess, but the whole world is very screwed up right now. But it has been this bad before. This is what happened in 2008. So it's not unprecedented and it's not unrecoverable. So in 2008, we had massive stimulus. Now we have massive stimulus. And the stock market is betting on this. We're betting on that kind of recovery. The problem is what we're not betting on is a couple of more quarters like this. And if there's no cure, if we don't do the right things, if we screw up, if the virus reasserts itself and we have to go to more drastic lockdown measures, we could be in some really serious problems. And oh, and by the way, this is only the first quarter. I'm sorry, this is that bad because this is only the first quarter, I just realized. So it doesn't even include quarter 2, which is, see, it's only -8. Your sense of proportion is screwed up. So if that's -8, this is -16, and -32 is like way down there somewhere, like far, far below the screen. So that's pretty bad. And that's the point, though. And then we catch up, and so now we're catching up, and real GDP change from preceding quarter. So it's the same thing, though. This is going to reverse drastically. So it's going to be down here, but then the other one is going to be way up here because it's going to be plus 30% from the previous quarter. It's a really crazy sort of change and wild, wild swing. But why is it a wild swing? Because we put $2.2 trillion into it. And we're about to put another $2 trillion into it. That's obviously going to have an effect, okay? That's like, I think a person can hold maybe like 8 quarts of blood. And so when you give them a 2-quart transfusion, that makes a pretty big difference, right? When you put 2 quarts of blood into somebody, that's a pretty big thing. So if you put 8 quarts of blood into a person, if they had any blood at all left, they would be overflowing with blood. So we put basically a couple of quarts into, or not quarts, pints, quarts. We put a couple of pints into the economy, and of course it's having an effect. But the thing is, what happens when you stop? Oh, there we go. There's something more proportional. Except that was their estimate. It was actually much lower. But there's a comparison to this crisis. But the thing is, though, here we have that slow recovery, and here we're going to have this really fast spike back up. But it's compared to this. It's going to be compared to that. It still has to all even out. You still have to have enough here to erase what happened here before you're back to an even keel economy. So we will see what there is to celebrate in the near future. But right now, everybody's very excited. We'll see what the Fed has to say at 2 o'clock. So let's see. Charlie says, I had an early spread in WBA, worth widening out the spread to 40-50 at this point. So he had a WBA spread, very off topic, but what the hell? WBA. Yeah. You guys gotta be kidding me. Okay, so so basically saying, would you roll down the $45 calls down to the 40 calls because it's cheap to roll? I sure would. If we look at WBA over here. So in other words, well, I lost it. So in other words, when the stock gets cheaper, what do you do? If it's a value stock and you don't see why it's going to get any worse than it is, let's see. What was the history of WBA? I was looking it up somewhere. Oh, I know. It was on there. That's why I can't find it. All right, so WBA. If you have the, what year was it? It was probably, didn't say. He has a 2022. All right, so you've got the $45 calls for WBA in 2022. And those are 280. So if we take those calls at 280, what can you do with them? The 40s. Nope, the 45s. So you have the 45s at 280. And the question is, what are you going to do with them? Well, 45 is a long way from 36. 40 is a pretty long way from 46. You only have a year. If you roll to the 40s, it's going to cost you $1, $2. Let's say it's going to cost you $2. What could you do instead? Oh, I'm sorry. You're short the 45s apparently. Oh no, I'm sorry. You're short the 50s, and they're only $1.50. So you haven't had much movement between the two. But the problem is they're in the wrong position. So I would probably, given that your 45s are 280 and these guys are 180, so you have a $1 spread, I would just kill the spread. I don't see the point. I would go and I would set up a better spread, and let's say you spend $2 on this spread at 250 on the $5 spread, you're down $1.50. So I would take the, let's see what you could take. If you go with the 3250s, those are like $8.50, $8.75, $9. And if you sold these, yeah, that's what I would do. Maybe the 3750s. Maybe these. Oh, these aren't bad for 10 though. I mean, then you're spending a lot of money though. The 3035s are 10 and 720 something, say 725. So say that's going to be 225 and you have a $1 spread. So you'd be spending $1 more. You'd spend a lot more money to do that for the 3025s. I guess the 35s, and we could call those 7 1/4, and then the 4250s are going to be 475. So 475, 25 is 5, and then 5 is 250. So it would cost you $2.50 to move to the 2023 35 4250 spread. Now, given that we don't, I mean, I would then sell some calls against it possibly, but it is very low in the channel WBA, so I wouldn't be too aggressive with anything like that. Unfortunately, you started with such a tight spread, it's very hard to do. It's very hard to work your way out of easily. But I would invest the money because you're going to invest in it. You're going to invest $2.50. I'm sorry, you're not going to invest $2.50. The 30s are 10, let's say, and so the 30s are 10, and the 3750s are $6.50, for example. No, that's not the one I said, though, was it? It was the 40s. It's this one for 8, 9, no, 10. I'm sorry, I'm just trying to figure out the best way to go. How sure are we it's going to be that much higher? I wouldn't mind that. Oh no, I'm sorry. We did the 45s. That's where it was. 35. Sorry, 35s. So the 35s arguably 725, 750 range. So let's say 750 worst case. Then the 4250s are at least 475. All right. So we said 750 just to be sure. So it's 750 minus 475 is 275. So your worst case is 275. You're going to spend $1.75 more, but you're going to drop your calls from the 45s to the 3250. I'm sorry, to the 35. So you're going to drop your call $10, and you're going to widen your spread by 250. So I mean, that's the way I would go. I would spend the extra money. I'd make the investment. So let's say that you did that, but you spent, let's say you spent 250 originally. Well, you're getting $1 back here, so you're spending 175 more for the roll. So what you're really spending then is 250 plus 175 on the new roll net is 425, and you're going to be in the $7.50 spread. That's plenty of upside. You don't really have to mess around with it. But of course, if you double down at what do we say, 275? If you double down at 275, divide that by 2, you're going to average in for 350. So the question is it worth spending that extra money just to bring your average down so that you get a clean double instead of like I forgot the number. 7.5 minus 2.75 minus 1.75 on the roll, $3. So you make $3 off your investment. I would just leave it. I wouldn't be fancy. Just be happy if it goes up and you make, you know, whatever, 60%, 70%. I'd be happy with that. I wouldn't go chasing this. You don't have to, every position doesn't have to be a huge winner. And of course, you have to look at also the concept of like, maybe you don't need this position at all. Maybe it's not worth keeping for 2 years to make that much money. Knowing me, of course, I would obviously sell the puts and then pay for a wider spread. Because to me, I'll buy this thing for 30. But that's what you see me doing the portfolio reviews all the time. If a stock gets cheaper, I don't want it less. I don't panic out. Look at WBA. That's not WBA. For one thing, when they do have virus shots, probably going to be going to like Walgreens and CVS to get your virus shots, and imagine like every single person in America going there. I mean, there's going to be clinics. You'll probably go to your supermarket too, but like, a lot of people are going to go to these places for virus shots. So they pay a 5% dividend, not that we're trying to get it, but they pay a 5% dividend, which keeps them fairly steady. See, the thing is, the P ratio, when people look at it, it looks like it's 43, but when you actually look at what they make, and it's just like the GDP. See, this is the funny thing, because you guys, investors will ignore a spike down in the GDP and say, oh, it'll come back. What's the big deal, right? But you won't ignore a spike down in the stock. Walgreens, they did a difficult merger with Boots, and then they divested, they bought Rite Aid, they divested a lot of Rite Aid. It's a big mess. And there's a lot of debt and blah, blah, blah. But they did it all with a good strategy. In 2016, 117 billion, 118 billion. There's a good track though, right? They went from 71, 72, 76, 103, 117, 118, 131, 136. This is really good growth. Not tech company growth, but it's for retail. This is lovely growth. And are they killing themselves? Well, back in the day, they were pretty steady, 2 billion, 2 billion, 2 billion. Then they started their aggressive expansion. Look what happened, 76 to 103, 2 billion to 4 billion, 4 billion, 4 billion, 5 billion, step back, 4 billion, okay? Now, what are they doing quarterly? And let's not forget they're closed. Now, this quarter had no effect, 1 billion. Remember, they made 4 billion the year before. In the first quarter of 2020, they made $900 million, $950 million. They were perfectly on track. What happened in March The problem for them is their quarter ended exactly. They didn't have a pretty good first quarter like most people. That was hit slightly, and then they got slammed because this quarter included March, and it was March, April, and May, and they got clobbered. And then June, July, August, not going to be that much better, frankly. So they're going to lose this money. But are they losing this money because of it? They made poor decisions? Are they losing this money because they ran their store badly? No, they're losing the money because it's a virus and half their stores are closed. They got all kinds of problems right now. That's why they lost money. They have an overhead. They can't afford to have less revenues. They can't afford for the mix to change. And that's a big problem too. A lot of people aren't, they're still buying drugs there, but the drugs are not as profitable as like the sundry items and things like that. They make more money on. People aren't shopping. That's why Walgreens merged with Boots. Walgreens is a very retail-oriented pharmacy, so it's a grocery store. They're like a grocery store practically. And Boots is too. Boots is really a place you go to buy things. It's not. It just happens to be a pharmacy. But in the UK and other parts of Europe, Boots is basically a store that people go into to buy candy and buy sundries and buy items. Just like the crap you have at Walgreens. So they made a good merger. They've had the same philosophy of like, this is what we need to do to make the most money. Great philosophy when people are coming to your store. Terrible philosophy when no customers show up. This is not their fault though. And how long will the virus last and how long will it affect them? I don't know. But you know what? When it stops affecting them, they're going to go back to making $1 billion a quarter. Unless they go bankrupt. They might go bankrupt, but probably not. They got plenty of money. They're not in trouble. So they'll go back to making $1 billion a quarter. And the bottom line is, how much money does it cost me to buy this company now? It cost me $31 billion to buy a company that is going to make $4 billion a year. Maybe not this year and maybe not next year, but they'll get back to making it. And I want to own the stock when they do. That's all this is about. The problem is, and that's why, by the way, I am inclined to move to a position that buys me more time. If I can go from 2022 to 2023, I'm buying myself another year. I really do believe the virus will be dealt with by then. And even if dealt with means we have herd immunity because everybody got it already. Okay, fine, at least everybody got it already. And by got it already, of course, I don't mean, everybody's sick from COVID, but 10% of the population, probably getting towards 15% now, have antibodies. That means we've been exposed to COVID, but we did not. But for the most part, we didn't have any major symptoms. And that's like all of us, right? During cold and flu season, you have the sniffles. Sometimes you have a slight cold for a couple of days. You sneeze a little bit, and then it goes away, right? Because your body fights it off. So some people are lucky, and they are mildly exposed to COVID. Now, not to get into a whole thing here, but basically the basic concept of getting a virus is you have an immune system. Your immune system is either trained or untrained to fight a certain kind of virus. If your immune system is trained to fight a certain kind of virus, it's going to suppress it better. A vaccine trains your immune system to recognize a certain virus, and that way your immune system is ready to respond. It catches it when it enters your body. If your immune system doesn't recognize a virus and doesn't get on it in time, the virus has a chance to settle in and multiply. So with mild exposures, and we all get mild exposures, and this is part of the concept of building the herd immunity. When you are mildly exposed, so let's say, I wouldn't know the number, somebody who's probably a doctor could tell us, but there's a certain amount you could have that can give you like a little bit of something in your throat or a little bit of a bother, and then it goes away quickly because your immune system reacts to it before it has a chance to entrench itself in your body. That's what it's all about. It's about knocking down the amount. When you get rid of a cold, your body is slowly but surely knocking out all the little viruses in your body. So when you get this COVID also, you can get a very small amount of it. You can be exposed to a very small amount, and it doesn't get a chance to multiply in your body. And because your body did fight it off successfully, you end up with some immunities that hopefully last a while, and you're more resistant. So that's effectively what herd immunity is people do get exposed to it, but not everybody gets the disease they're exposed. Just like in the flu season, right? If you're lucky, you get a sniffle here and there, you get a couple, maybe you get a cough, maybe you get a mild sore throat, but it all goes away pretty quickly and you get through the flu season without having the flu. But sometimes you get the flu and you are sick of the dog for a week or something like that. That's tough. That's when it got entrenched in you. And if it gets more entrenched, it develops into worse things and so on and so forth. So every disease is kind of like that. So right now, 15% say of the population has been exposed, and of the and we've only registered. Let's see. Well, let's see. Last week, no, not last week. 2 weeks ago. Oh, this will be shocking. All right, last week there were 6.9 million cases, 31.7 globals, 200,000 dead. Oh, I'm gonna write this down. So 6.9. What? Try that again. 6.9 plus. How about that? 31.7 plus 201,000 U.S. deaths plus 972 global. So that's how many global deaths is the last one. All right, so here we go. There's too many numbers to remember at once. So where are we now? 2 weeks later. Okay. Very slow. So now we have 7. Wow. That's pretty horrifying. See, that's why you got to write it down, because it's like you go, is that real? We had 6.9 million infected people. Now remember, that's officially infected. That's not 10% of our population. That's like 5% of our population. 5% of our population. Wait, is it 5? 300? No, it's not. It's 2%. Sorry, 2%. 2% of the population has been officially infected. But when they do testing for antibodies, they find that 10 to 15% of the population has been exposed. So of the people who are exposed, if 15% of our population is 45 million people, 6.9 million people, about 15% of the people exposed develop symptoms serious enough to merit the attention of the authorities. Now, I guess if they're testing, and this was Donald Trump's complaint, if you're going to test everybody and you're going to call people who have antibodies infected, that's different, right? Then you're going to add them to the total. But when they do broad spectrum testing, like they test the whole city of Albany or something like that, they've done a couple of cities like that, and they said, look, 15% of the people have been exposed. They've had antibodies, but they're not active. That means they had it, it was mild, they went through it, it was over. So if you do test people, and like they tested all the White House people every day, that's an advantage Donald Trump had. They test you every day. That means as soon as you're developing any sort of indication of the virus, they start fighting it right away. Most people obviously think they have a cold, and then it gets worse and worse and worse. And by the time they go for treatment, it's in bad shape. Trump went for treatment the day he turned positive. You know, they take him right to the hospital for that. So that's different. So but again, that's why testing is good. Testing is important. If you test people regularly, you catch people before they get dangerously ill. But anyway, so in 2 weeks, 6.9 became 7.5. 10% of our population became infected. I'm sorry, 10% more people. We had 10% more infections in 2 weeks. That's a really horrifying number. Globally, we're way ahead of the globe. On the planet, well, no, we're not. I'm sorry, I apologize, not true. Here's 31%, not 31. Here's 32, and here's 36. So basically 4 more. So at the same pace, the global infections are spreading too. All right. Death-wise, we had 211,000 deaths. We have 201,000 now. 5% growth in deaths. So 10% growth in cases and a 5% growth in deaths over 2 weeks. Bad, but not we're getting better at treating it. That's for sure. We're getting experience. We're getting our 10,000 hours of experience in treating COVID cases. And then globally, 972 went to 1051. That's 75 more. So it's a bit less than 10% more there. But the global death rate is worse than the US death rate. We are better, and Trump has said that, we are better at keeping people alive who get COVID. Not that much better, but we're doing a little bit better than the world average. Now, it's possible that we are not carrying our statistics properly because of the way Trump manipulated the data at the CDC and whatever, but more or less you kind of get an idea the US we're not leading in deaths, and it's actually good considering we are leading in cases. So we're a world leader in number of cases, but we're not leading number of deaths. So somebody's doing something, I don't want to say right, but right-ish. Anyway, but here's the thing. So if we extrapolate our 15% and we say that this represents 15% of the people who have actually been exposed, then we're saying that 6 times more people, so 7.5 times, 7.5 times 6, 45 million people exposed, but that's divided by, 320. Yeah, whatever. So only 13% of the population has been exposed. That means we have 6 times more people to be exposed. At the rate we're going, if it's 10% in 2 weeks and it's 20% a month, 7.5 million people times 0.2 times, that's 1 month. Whoa, what was that? 7? Oh, I know what I did. It's got to be 1.2. 7.5 times 1.2 times 1.2. So that's November, December, January, February, March, April, May, June, July, August. Well, what'd I do? Frick, now I lost track of where I was. Anyway, let's say that was August. September, October. So next year, 66 million, and that is going to be enough where most of the population, that's infected in the way that we're counting these 7 million infected now, seriously infected. Whereas that by that time, pretty much the whole population will have it. So although that's a depressing number, and although that means probably, even if we do a good job with the deaths, we're probably going to have, 1 million dead people. On the bright side, at that point, you've reached a herd immunity where we've all been exposed. Now, we don't know for sure that being exposed once to corona is going to make you immune. We get the cold all the time. We get the flu constantly. They never get immune to the flu, and they never come up with a vaccine for it. They have a shot, it helps you build immunity, but the reality is it doesn't 100% prevent you from getting it. It does do a pretty good job. But in any case, even if you assume that they don't come up with a good vaccine, they don't do this and that, by this time next year, it'll be over. And that goes back to where's your long-term premise? My long-term premise is, even if Walgreens loses another 1.5 billion a quarter for the next 4 quarters, and that's of course the worst case scenario, it's still going to be over by then, and the world will start to get back to normal. And even if we do get it again like the flu, they'll probably come up with a booster vaccine. We'll be good at curing people. Things will be much more back to normal in a year, no matter how awful this seems. So then how do you do it? Then now you got to look at Walgreens and you say, okay, so this sucks. We're going to lose that much, but then you got to go to the balance sheet and you got to say, okay, balance sheet. Receivables, inventory, assets, 18 billion, Okay, blah, 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 goodwill is bullshit, blah, 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 total assets, whatever. Okay, liabilities, 26 billion. Okay, long-term debt, 12, other non-cash, long-term liabilities, 38. That could be whatever the payoff of Rite Aid or other things, who knows what they're doing. Anyway, but the bottom line is, if they're 38 billion if they have 65 billion total liabilities now and they're managing to pay it, what if they lose $6 billion more for the next year? Well, then this number's up by 10%. Not going to bankrupt them. And especially if you say, well, do they drop 10% to the bottom line? All right. So, oh, sorry, the wrong one. Ugh. Income statement. Let's try that. So do they drop 10% to the bottom line? No, they do not. They're a retail company, so they drop $4 billion to the bottom line. But you know, if you borrow $6 billion, you know it doesn't cost you $4 billion a year to pay it back. So even if if you figure they'll pay it out over 10 years, that's going to be $600 million a year. That's going to take a hit on their bottom line. And then you can recalculate their income and say it's, well, let's say it's only $3 billion. Okay. Let's say, I mean, let's be worst case. Let's say it's only $3 billion a year because they got to pay back another $6 billion in debt. That's still not bad for a $30 billion company. You got to think about the company like it's a real business, like it's something you're going to operate over time. You can't think about everything quarter to quarter to quarter. Especially in a depressed market, especially in a market where we're going to have a long-term recession. You have to start thinking about like what's going to survive a long-term recession. And if you had asked me that in 1935, I would have said, well, you know, there's this AT&T as a phone company, and you've got the Edison Electric Company, and you've got IBM typewriters seem to be very popular. You know, you would have picked good companies, right? Exxon, Standard Oil, I guess it was at the time, Standard Oil. You know, you've got to pick good companies that have a strong future. And not fads, not momentum stocks, but companies that are going to be there for the long haul. Is there going to be a pharmacy in the future? Will it necessarily be Walgreens? I mean, you could have said Rite Aid 2 years ago and you'd be dead wrong, right? Rite Aid fell apart. But they got their asses kicked by Walgreens. They got their asses kicked by Walgreens and CVS. They wiped out all the competition pretty much. And I know you New York people are probably saying, well, what about Duane Reade? That's Walgreens. Duane Reade is Walgreens. Because in New York, there's like a Duane Reade on every corner. So you got to look at that when you're making these investments for the long term. So that's why I said I would just move back in time. I would just increase my position because I want to own this stock. It's a good value stock. And I've been banging the table on it for ages. It hasn't improved yet. Not everything improves when you want it to. Not everything goes straight up right away. But we've had these conversations about SunPower for how long, right? There you go. Okay, it took forever. And I'm sorry. Things don't go right up. Just because we decide to buy them doesn't make them go up. Things do take time to realize themselves. SunPower was stupidly undervalued. And we had it this whole time, basically. We always buy SunPower, but this year I was really crazy about it because it's so cheap. And I look like an idiot for buying it, but now it's taken off like crazy. How's OPTT? That doesn't count, but they just suddenly took off too. Here, OPTT, we've been playing for a long time. We got out of them here. We kind of lost interest in them when they took off. They went crazy high. We quit, and we haven't played it much since, but now they're coming back again. It's a shame because I wasn't paying attention. We should have bought them back here. But it's one of the penny stocks that we like to play with. Here's NAK. It's another penny stock. Not that I want to point out the penny stocks, but you know. So here's NAK still moving along. But for this year, when I've been saying buying. Now, if Trump gets reelected, this stock's going to go back to $5. So, so that's, you know, it's so funny. He first says he's going to protect the fisheries and the salmon from NAK, and then a week later they pass a ruling saying that that there's an emergency permissions to mine rare earths, which exactly opened up NAK. And it's so funny the way they did it, because they go, they make these noises, which I knew was bullshit, to depress the price. This is them making, this is when Trump Jr. said that they would protect the salmon, and it was more important than mining, blah, blah, blah. So the stock went crazy down. I said, buy it, buy it, buy it. And we bought it. And so this was the actual day we bought it. And it went flying back up, because the reality is that it had nothing to do. It's like the stocks go down based on something Donald Trump Jr. said, and then Donald Trump saying something. You're going to drop the stock on two liars talking about something? That's ridiculous. So we jumped in, and the reality was, of course, that it was all bullshit, and that they came back here just last week, and they suddenly said, okay, it's now an emergency that we're able to mine rare earth. So let's see. Rare earth. What did the news say exactly? Here you go. So, I mean, how much more obvious bullshit can it be? Donald Trump signs executive order aimed at expanding domestic production of rare earth minerals that are vital to the manufacturing sector. The order declares a national emergency and directs the Interior Department to explore using the Defense Production Act to hasten the development of mines. It is exactly the opposite of what they said they were doing. So what he's done is he's taken this thing, this Pebble Beach mine that was stuck and in regulatory hell. He tells the people how he cares about protecting the salmon and fish and blah, blah, blah. And then a week later, literally a week later, he declares a state of emergency that allows the mine to go forward despite any environmental concerns, with much less, without having to put in the heavy protections that they were being asked to put in. It's freaking insane. They say one thing, they do another. It is absolutely insane, and people just let it go. Because there's so much, they do so much of it that you can't even deal with. The barrage of bullshit that comes out of this administration is amazing. But they're just basically throwing regulations out the window. He declared a state of emergency that says you can strip mine the world. And the funny thing is, they say for rare earth. A rare earth is not rare, okay? A rare earth element is an element that is rarely found, but they are in fact widely distributed. They are just, they have a rare density. There's very little of it. So you have to strip mine unbelievable amounts of material to get a little tiny bit of like tellurium or something like that. It's just a very, very, very rare material that is in all over the planet, but in such small quantities that you have to sift through billions and billions of tons of rock to get some out. And that's what the problem is. So rare earth is not rare in the sense that, oh, it's only found here and there. It's not like gold. It's anywhere you can find basic minerals, you can find rare earth elements. And there are certain places, obviously, where it's more concentrated, and it's the same places where you will find gold, silver, copper. So that means that anybody who wants to strip mine in an area where strip mining pays off, where regular mining, where pit mining does not. If you have a mine shaft, you've got a very huge expense in machinery and equipment and so on and so forth and blah, blah, blah. If you're strip mining, you're just destroying a mountain and you're sifting through it for stuff. But strip mining is horrifyingly bad for the environment. And of course, that's what they want to allow. So now we can go strip mining, and all these people, and Trump is going to allow the use of federal lands and let people open up and take national parks and like knock them down and tear them apart. And then after they're torn apart and after they flatten out everything and they put down artificial grass where there used to be like trees and forests, then Trump's going to say, oh, you know what? We should put some hotels here. It's just too funny. I mean, it's really amazing what they get away with. So let's see. All right, so that's Walgreens, LYG. Brendan says, did you close out the LYG trade? We haven't been in Lloyd's in ages, have we? I like Lloyd's on and off, but I don't remember picking him for a very long time. So you're kind of stumping me with that one. It is Lloyd's, right? LYG? Lloyd's, yeah. Lloyd's is an insurance company, and they're famous for insuring pretty much anything, and that sometimes bites them in the ass. So when they're cheap like this, they're kind of cute. Let's see. Let's take a quick look. LYG. Howie. Oh, it's Powell time. We got 500 points right now. And Powell's about to. Oh, no, he's not speaking. I'm sorry. It's just the Fed minutes. It's just the minutes are coming in. Where was I? Oh yeah, Lloyd's. So yeah, look at the PE ratio on Lloyd's. So you're paying $26 billion for Lloyd's. LYG. So, you know, they're not consistent. They're an on and off company, but it's based on insurance revenue. The bottom line is how good are they at guessing? I mean, that's their job. Their job is to insure things, but they do it more like a gambling operation. They honestly do. They run their insurance company. They obviously have regular insurance. They have actuarial tables, but they do a lot of weird insurance that I always check with Lloyd's if I have to insure something, because sometimes their rates make sense and sometimes their rates are insane and sometimes it's in your favor and sometimes it's not. But it's always worth checking if you need like certain business insurance, like when you have to have insurance and you don't really think it's necessary. So they're good for that kind of stuff. Anyway, so, you know, income 3 billion, 5 billion, 5 billion, 4 billion. Let's see how they're doing during a crisis. Oh, not much to go on here. So only 600. Well, 600 million is not terrible. All right, so 600 million came in here. No, but that's not 600 million actually, because if you look at that, so you always got to watch that. Oh, the tax is consistent. So they got a big tax credit for something, but they only made $100 million. So that was terrible. So they had a very terrible quarter here. Probably not a good quarter. So they're probably having some bad times. It's, wow, what is that? Minus 22. What? I don't know if that's even real. That seems odd. That's very odd. What does Yahoo say about them? And where did you get that kind of number? Oh, here, quarterly. Oh, they've got it 630. See, look at this. Interest income, net interest income. What the hell is that? I don't know. We'd have to find out what happened to them. But anyway, so again, though, when things get back to normal, not a bad thing to own, but then you have to kind of worry with Lloyd's, will they ever get back to normal? But their balance sheet, you know, they got 800 billion in assets. Insurance companies, obviously liabilities. They've got capital, book value, total debt, blah, blah, blah. Look at 105 billion in debt. That's crazy. It's difficult. You have to be careful when you're analyzing an insurance company like this and figure out what they're doing with the money. Another problem with insurance companies is when it's low interest rates, they're supposed to be, by the way, I wouldn't even believe Lloyd's does this. They're supposed to keep their money into very safe annuities, like T-bills and things like that. I bet you Lloyd's doesn't do that. I bet you they gamble with the money too. But they are a 200-year-old institution and they generally know what they're doing. I mean, on the whole, they take aggressive risks. Some pay off, some don't. But so does Goldman Sachs. I mean, that's what they do. Except Lloyd's does it under the guise of being an insurance company. Like, for example, if you are pushing oil, if you're pushing oil through the Straits of Hormuz, and which obviously 1/3 of the world does, and you want to insure your tankers, when the tensions in Iraq and Iran flare up, the insurance rates start skyrocketing, right? Because now you've got a much higher risk of something happening to your tanker. So if there's no tension, a regular insurance company will say, okay, well, there's historically, there's a 1 out of 600 chance that something bad can happen to your ship, or 1 out of 6,000 chance, whatever it is. So we're going to charge you 1/6,000th effectively, or 1/5,000th, because they want to make a profit. We'll charge you 1/5,000th of your shipment to insure it. So your insurance cost is 0.5%. That's reasonable, and people pay that for insurance to insure their tanker shipment. It's not a big deal. If it was, it wouldn't even add a penny to a price of a gallon of gasoline. So that's the insurance cost of making sure your shipment gets from Saudi Arabia through the Strait of Hormuz to the United States and goes in and gets into your tank. Fine. Now, what happens when there's a war? Now, when there's a war, all of a sudden, a prudential kind of insurance company, a regular insurance company is going to say, oh, no, we don't want to insure that. Now there's a war, and we have no idea what's going to happen. And if we take it's not so much that the odds go from 1 in 6,000 to 1 in 600, right? There's 10 times more chance that there will be an insurable event. It's that the one insurable event, if it hits a company, a regular insurance company gets hit by an insurable event like that and loses a multi-billion-dollar tanker of oil, then that insurance company can go broke. They can't sustain a loss like that. So insurance companies won't insure it, or they'll charge ridiculous rates, or so on and so forth. Whereas Lloyd's is very strategic, and they'll be like, oh, we love insuring that. Sure, we'll insure it for just twice as much as it was before, because they say, you know what, it's a good gamble. We're going to win a lot of customers, and in the long run, we don't think, in the long run, historically, because they look at a bigger picture, they'll say in the long run, historically, we still think the odds are this much. Out of all the tankers that go through, the odds are this much. And if we get a hit, we're big enough to deal with it. So they're gambling. Other insurance companies don't gamble. Regular insurance companies don't gamble. They play the statistics, and they make sure they're going to be on the winning side. They make it so it's very, very difficult to lose, because they don't want to take those kind of hits. Lloyd's is willing to take the hits. They're more gamblers. Then they insure a lot of stuff that other people won't insure. So that's the story of that. But that's why I like Lloyd's, especially when they're down, because sometimes they go down in cycles because they made a mistake. They go, oops, we shouldn't have insured that. And then it takes them a while to get back on their feet. But like in 2008, we did this with Lloyd's. And that's why I still can't, I'm baffled, because I don't remember buying Lloyd's for the last 10 years. I might have mentioned it, though. I honestly don't remember. But yeah, so here's what happened. So in 2008, they made a huge mistake. They insured a lot of mortgage-backed securities and things like that. They got totally destroyed. And that's when I was banging the table on these guys down here. I was like, this is an insurance company. They'll get back together, blah, blah, blah. And they did. So we wrote them out. We had a thing, and then we had them. And then when it came back up here, we were like, oh, that's good. We made a ton of money. And then we were done. I honestly don't remember ever picking them in this section here. I don't know when this happened. But in either case, though, I do like them down here. I think this is a little bit silly how low they are right now. That's a very interesting play. I like that. Oh. There was a guy who's new. I think he's new. If he's either new or he just never talked. But somebody in our chat room had a question. I'm going to get back to that now. So in our member chat room, wow, that was messy. Okay. So Marcel was saying that he has all these positions, but it only turned out to be this many. It's not so terrible. But he had on AYX, he was asking about it. They had some rough spots and some problems, but I think they're probably going to stabilize out around here. So it's not a bad spot to be. But the problem is he did weird stuff. He sold the 150 calls. He sold the 160 calls, but for next year. And I'm not sure when he sold them. I guess we can tell by the prices now. So AYX. Can't really put both up at the same time. But he sold the 150 calls. The 150 calls are now $40. Wow, I think he did something really wrong. Oh yeah, he did. Okay. So if I had to guess, and we got to talk about this in chat, because it's complicated, I got to take it seriously, so I'm not going to do it quickly. So if I had to guess what happened is he had the stock here. He had this spread. He had 500 shares at 145. He sold the 160s. So he was in around here. All right, because he couldn't have bought him 145 since the problem. So he's over here. He's bought him at 145-ish, around here. Sells the 160s. And that was his original spread, I imagine. He probably sold some puts too. But maybe these 5, who knows what he did. But he sold some puts, he sold some calls. Oh, the 150 puts, that's painful. See, I don't know what he did. I don't know what the sequence was. But he had a normal spread. Let's say he had this and he sold 5 puts of some kind, or the 100s or whatever he was doing. And so he had a nice little spread, but then the thing dropped and he panicked. And it fell below his 145. So what does he do? He tries to lower his cost basis by selling the 150 puts. No, I'm sorry. He sells the 150 calls and he sells the 160 calls. So he's way overcovered by a mile. And then the stock popped back up on him and he's totally screwed. Because now he's losing here and he's making money on the short puts. But he can't make any extra money on this because this is locked in. He didn't buy these back or do anything. He's going to be called away in October from the stock because now it blasted back through 160. He was panicking it wouldn't get to 160. Now it's going to blast back over 160, and he's going to be totally screwed by these short calls. So how would you fix something like that? You got to kind of look at this as being cash. So he's got $72,000 here. And it's going to be obviously a little bit more than that at 160. It'll be $80,000, right? 500 times 160 is $80,000. So he's going to have $80,000 cash, and he's got the November 160 calls are useless. He's got I mean these cancel out these Octobers. He bought 5 Octobers, bought 5. Oh, he didn't sell 5 Octobers. I'm sorry. He covered with, I don't know what he did. I'm sorry, he's going to get called away on these at 2022 160s. So he's going to get called away on these calls. Bought 5 calls. I missed that. So he bought 5 calls also. This is a mess. So these look, these are dead effectively, right? These are not. He's not covered here, but he's covered here. He's got 5 of these covered with I don't even know what he's doing. He covered it. Are you bullish or bearish? That's the problem. I wrote that to him too. I'm like, I don't get it, because you bought 500 shares, then you sold 2,000 shares basically to cover 500 shares. Sold some puts, nothing wrong with that. Sold some more puts, getting a little excessive, but that's okay. And you bought short-term calls. And I'm not sure why or when. You bought them really cheaply, so I assume that we were down here and you bought calls, but you didn't give them enough time to get up. So anyway, so these are cheap, so who cares? These are cheap and these are dead, so that's out. So I really just erase those. And what are we dealing with? We're dealing with the shares you're going to cash them for $80,000. So those are gone for 80. And where are you now? That leaves you with short 150 calls, short 160 calls, short 150 puts. So really all you got to do to fix this is take your $80,000 and buy 20 of a lower priced option long term. So let's see how much that is. So if we go out to 2023 and you buy, well, you're in the 150s. So let's say we buy the 140s. The 140s are 50, they can't really tell here. So the 140s are like 50 something dollars. You say you have the short 2022s. If you buy the long 2023s and you spend, well, here's 55. So let's say you buy the 135s for 55. It doesn't matter. But you're gonna buy 20 of those, it's gonna be $110,000. So basically, if you cover with 20 of the 135s, that would then leave you with the short 150s, the short 160s in 2022. And then you would have the short puts. So hopefully the short puts expire worthless, the calls expire worthless, or you're going to roll them to an even wider spread. and you'll get your money back eventually. That's about the best way to do it. That's going to keep you from getting buried. And of course, when you're either going to roll them along or you'll do it again. But again, is that the right thing to do? Well, at the moment, you're pretty screwed with how fast they went up in price. So you need to do something to cover it. So that's the problem. It's sort of, there's no really one answer. It's a question of like, well, what are you doing? What's your buying power like? How, what are you trying to accomplish? So on and so forth. Anyway, Powell, back to the Fed. So sorry about that. I thought we could easily fix it, but I'm looking at it. It's much more complicated than I thought. So now we go POWELL. Oh, actually, it's really the Fed minutes. Powell, Fed news. Why is this all so old? I thought they were doing Fed minutes. FOMC minutes. La di da da da. September minutes, October 7th. PDF HTML. I am not going to read this. I'm telling you right now. You know what it was? They used to have the minutes in a nice format, and now it's like I really hate them. I mean, they're all over the place. It's tedious. Look at this. It goes on and on and on and on and on. So let some professionals do it. Let's take a look at the Wall Street Journal, see what they have to say. Really? Here you go, Fed. There we go. Many show officials grapple with how to tailor their new frameworks for the pandemic recovery when they met last month. All right. This did obviously, at the moment, this has done nothing to bother the markets. We're still chugging along back at yesterday's highs. So I guess that's a good thing. So Federal Reserve officials wrestled last month with how to apply the new framework to a battered economy. Official raised the bar for interest rate increases. At that meeting signal, they expected it would be at least 3 years. Oh, there you go. That's going to hold the economy up. 3 years before they're going to raise rates. Fed officials laid out a 3-part test that must be met before they're considering. So not only 3 years, but there's a test now before lifting rates from 0. They need to be satisfied the labor market conditions meet the maximum employment goals. We're obviously 100 miles from that. Inflation must be 2%. They will need some evidence that inflation will continue to be 2%. So it can't just be 2%, it has to be consistently 2% and going higher. 2 members dissented, and that was Kaplan wanted less precise guidance. That's weird. And I don't want such precise guidance. And Fisher, Kashkari wanted more. He wanted to be more stimulus. New projections. Now remember, Kashkari was the TARP guy. He was overseeing TARP, so he knows. His experience from TARP is saying you need a certain amount of stimulus in this economy, and we don't have enough of it. That's what he's basically saying. So I think he's right to some extent, but to another extent, I think, obviously we're distorting everything with the markets. We're not helping the right people. New projections released last month show officials expect a somewhat stronger economic rebound, speedier drop in unemployment, but there is still considerable uncertainty over the path of the virus and its implications for growth, hiring, and loan losses that could weaken the financial sector. Well, that's what we're talking about now, right? Several Fed officials expressed concern at the prospect of delayed or reduced financial support from Congress and the White House after exposing. Look, they're concerned about the same things I'm concerned about, right? They're concerned about what happens when the stimulus runs out. Can we stand on our legs by ourselves? Is the economy going to continue at this pace? These are things you should be concerned about. And they expect, and their optimistic forecast is premised on $1 trillion in additional spending. That's the minimum they saw. We got 0 so far. Powell said he saw great illicit risk of doing too little than spending too much. The expansion is far from complete. Trump said he was suspending. All right, well, we know that. Blah, blah, blah. Fed officials who also expressed expanded their asset portfolio with stated goal of repairing major market malfunctions. They're meeting in June. Provide more clarity. Ugh. This is useless. These purchases maintain, blah, blah, blah. The Fed has been purchasing $80 billion a month in treasuries and $40 billion a month in mortgages. Well, let's think about that. This is in addition to the stimulus. $80 billion a month times 12 months is $1 trillion. They're buying $1 trillion in treasuries and $500 billion in mortgages. That is $1.5 trillion of additional stimulus from the Fed. They're buying up paper, all the money that the government's borrowing, they're buying it. And they're buying up mortgages to keep the mortgage market afloat. So we were talking about the 2.2 trillion the government spent, and here's the Fed spending 1.5 trillion on top of that. So now we're at about $4 trillion in stimulus just from these two guys, and that's without the government adding anything else. And that's where your healthy economy is coming from. That's your healthy stock market. Reaffirming the reason for these purchases done nothing to elucidate the circumstances under which the Fed might adjust bond purchases. These questions include whether and how to link guidance, blah, blah, blah. Okay, who cares? So that's that. It's certainly being taken well. No problem from the market. Anything else exciting? Eli Lilly asked the FDA to authorize the antibody test. That doesn't help anybody. Trump's COVID diagnosis amps up spotlight. 6, chicken industry are indicted for price fixing the chicken industry. Wow. An asset light economy. I like that. That's good. All right, so that's where we are, guys. I mean, it's unfortunately nothing really particularly great about this. But we are back. Oh, damn it. That happens automatically. What? Whoops. There we go. So everything's back to the week's highs. We're plowing along. You know, Trump said no stimulus here, and then he said, well, maybe some stimulus here, and we go right back up. There's obviously we're into a very uncertain time, and I just prefer to be nicely balanced while we're doing it. And I talked this morning about the portfolios. Whoops. La-di-da. Hey. So we lost a little bit in the short-term portfolio here, because obviously the markets went way up, so we lost some money. So it's down to 491. That's interesting. Where were we this morning? The same portfolio. It obviously hasn't changed or anything. So it's a good lesson for how volatile this can be. We were at 514, now we're at 491. So we're down 25,000 on the short-term portfolio. And the long-term portfolio was 1005. So let's see how the long-term portfolio is doing. It's like how you take the temperature, you know, just see how the portfolios are running at any given moment to see if we're on track or not. So 1005 is now 1026. So we made 20,000 here, and we lost. I forgot already. Ugh. What did I say? Like 25. So we lost anyway. We lost a bit more than we made in the up market, and the reason that happened is because we're generally more bearish than bullish. So we actually had a really nice gain when we had that dip yesterday, and now that's been erased. But not in a terrible way. That's the thing, though. We're not terribly bearish, but we are bearish enough to make money on a bearish downturn. And we're just going to have to see how it plays out. And that's the trick though. We don't know what's going to happen. I feel better about being balanced. And the way we really make all the money is on all the short premium that we sell. So in other words, you know, Harmony is at $5. So the 3 puts are 100% premium. We sold $3,000 in premium. In January 22nd, 2022, that premium will expire worthless. No matter what price Harmony is, this premium will be zero. So we have a $3,000 advantage. What do you call that when you get it? It's a football thing. Spread. Yeah, that's our point spread. So basically, we're taking the over at $3 and we're being given a 63-cent spread. That's where we are. No matter what happens, we make the spread. We're always going to make that money. If it's below 3, we will then have to pay whatever it is below 3. That's going to be our cost, but it still doesn't change the fact that the premium will be gone. So these are sure things. The 42 puts on Coke, also 100% premium, $2,800. The $30 put on Micron, all premium because it's out of the money, $2,100. The $15 put on Mylon is right at the money, still pretty much all premium, $7,000. That's good for any trade too. And the same thing goes here. Berkshire is miles in the money. But at 212, the 190 puts should be $22, $22.69. How much are they? $41.50. Half of that money is premium. It's going to disappear. Now, a certain portion of our money is premium too. But that's why I talk about the value of the spread. There's a $20 spread times 15. So it's a $30,000 spread, 20 times the 15 contracts. How much is it currently? It's 83 minus 62. It's about $20,000. So this spread, once all this premium disappears, is going to be worth $30,000. It's currently worth $20,000. So it's going to gain 50% if Berkshire Hathaway stays over 190. This is how we make our money. And, you know, I know that it seems boring, but we did all this year. You know, this portfolio is up 105% this year, doing boring stuff like this. I know everybody likes action. I know everybody likes to do all these exciting trades and things like that. And everything, oh, what about this one? What about this momentum stock? What about that? What about that? It's like, that's fun. And it's fun to trade. But to make money, you want to do more sensible stuff. And you can make great money doing sensible stuff without, and how often do we sit there and look at the long-term portfolio? We hardly ever touch it. Once a month we review it and make a few changes. But generally, this is on track. In fact, look, here's our long-term portfolio review. Let's see how many things we actually changed. So about 2 weeks ago, well, you have to go back. Older articles. Yeah, there we go. So it would have been on like the 18th or something. Oh, here it is. Oh, 18th. Wow, nailed it. All right. See, I'm always pleased when I'm getting old enough when my brain works. I'm like, oh, yay. Okay, that was good. Okay, so in the short-term portfolio, and by the way, that's another, speaking of things, now the short-term portfolio is much more aggressive, of course. On the 18th, the S&P looking like this. No, not that. So here we were on September 18th. Actually, it wasn't even hot. It was right up here, right? So on September 18th, we were here. And, oh, no, here. And the short-term portfolio is here. So really, it wasn't that the hedges paid us off much, okay? But we did get more aggressive. What really happened is Tesla, which was killing us at minus 795 on these calls, and minus 106 here. So that's minus $900,000 on Tesla. So what happened since, is this a short-term portfolio? No, it's not. And now, very slow. Oh no, here it's done already. Not very fast. So now it's minus, oh, that's it. Look at the difference. Now it's minus 400,000. So we gain all of that. So all these gains, the fact that we're up like $400,000 since that time is because this Tesla position paid us back off. So obviously, and our goal was at that time to reduce it. I think I said something about it. I know I said something about that here. But this portfolio, as it is with these changes, went from 160 to 490. And really, it was all this Tesla position changing was basically the entire cause of it. We closed TQQQ, we closed it out because we decided we were done with it, but we took this money and we put it into other hedges. In SQQ, we made a rolling adjustment to make it a more aggressive spread, not paying off so far, obviously, but we have a more aggressive spread. We have a good hedge. SDS, also, we put money into it, made a more aggressive spread. CMG came back down a little bit, but not, oh no, it's really the same as where it was. So CMG, we did a roll. Tesla, we said next time we're green on the short calls, which just happened yesterday. We put tight stops on the half so we're not so volatile. So that happened. We basically just came out even on those short calls, half. We still have half short, but we don't have that crazy number anymore. And UNG, oh, I'm sorry, so that's not apples to apples because we're comparing 35, because some of it came out of the cash. This is really like minus 621, and that's minus 47. That hasn't changed. This one changed. So it would have been 640 if we still had 35 of them. So we actually bought back 35 of the short calls, and we're still minus 321. So, but the real change of that is from 900 to 321. So about 300,000, about 400,000 gain came from that trade. Not all of it, but most of it. UNG, we made a change also. So that's where we are. In the long-term portfolio, that was the point I was going to make. So here I am with the portfolio. Harmony, we got 4 things here. Yes, 4 things, check. So $2 entry is our worst case. I'm not worried, fine. Berkshire, Sterling McCalls. I haven't made these changes yet. I haven't logged them in yet, but there's Berkshire. So what we did was change, sell some short calls. Everything else, no change. Look at that. That's amazing. Wow. No kidding. No wonder I didn't get around to fixing that one. It's the only change. So we didn't change a thing in the long-term portfolio. We didn't touch it. The only thing we did is sell some short calls with Berkshire Hathaway because we thought it might pull back a little bit. And let's see what actually happened, by the way. Nope, wrong section. Berkshire, what actually happened? It pulled back a little bit. Or it's basically running along where it was. So that was exactly the right thing to do. So the only change we made was to raise a little bit of cash selling some Berkshire calls. And the reality of it is we went from 107%, we actually lost 2% in the long-term portfolio over the last few days. Not a few days, 2 weeks since the 18th. So we lost a couple of percent, but the portfolio is holding up very steadily, which is just what we wanted to do in a choppy market. And the short-term portfolio made a bunch of money to make up for it. Everything's according to plan. And then we take off some of that Tesla because it's too risky. It's hurting our performance. And well, I'm sorry, it was hurting our performance when it went the wrong way. Now that it went the right way, it helped our performance, but usually it hurts. It's too dangerous. So now we're back to a much more solid hedge. And we've got $1.5 million sitting here. And hopefully we can lock that gain in for the year because that gain is like up almost 200% for us overall because we started with $600,000 at the beginning of the year. So Brian says, I think your LYG trade was buy the stock and sell the $1 call. I honestly have no recollection at all. Oh, that's another good reason to own them though. Yeah, I see that. I honestly don't remember that though. If I did, I forgot to log it in. It was a great idea. NG for the hurricane trade. The hurricane season is pretty much over. Historically, this should be the end of it. So I don't know if I'd be going back to natural gas. I mean, the thing is, you got the global demand issue. Long term, do I like NG still? I do. But where it is now, it's been very weak. So on a monthly chart, on a weekly, see that's where my problem starts. If you can already see a problem on the weekly chart, like this may be the channel, and if this is the channel, why am I going to go long here? On a daily basis, you see it, you're up in the channel, you're not down in the channel. Here was a no-brainer. We called it long here. That I didn't mind. Down here, absolutely love it, because just fundamentally, you know, that's a value play. But when you're here, I don't have any definitive value thing here, so it's not something I really want to be calling. You know, if it was the beginning of hurricane season, I would be into it because I might go like this, but I don't think so right now. I think we're pretty much gone. I think that you're not getting a huge spike in demand. You're not, you know, it's the virus is hitting everyone everywhere. You know, natural gas is very much used for electricity generation, and people are not, you know, we don't have these offices aren't working. These cities, you know, people aren't going to work. People aren't doing stuff. We're using less electricity. A lot of electric intensive industries are shutting or low capacity, whatever. I don't think it's a great play right now. I really don't. I don't have a lot of compelling reasons to go long natural gas, so it's not something I'd really be shooting for. Any thoughts on short term on Apple into earnings? Nope. Problem with Apple is, again, it's not that cheap. It's just I know it's popular. I understand that it's a very popular stock. Everybody loves it and whatever, but it goes back to my normal Levi's thing, right? I like Levi's. I know I'm going to buy Levi's all the time, but I'll buy it when they're on sale. You know, so this is when I buy Levi's. This is when I buy Levi's. This is when I buy Levi's. This is not when I buy Levi's. In the big picture, this is not on sale. It's cheaper than the spike up to the ridiculous $2 trillion valuation we just had. But they're not worth $2 trillion. They only make $60 billion a year. It's kind of funny, right? They only make $60 trillion a year. But still, that's true, though. I'm 60 billion. So 2,000 billion divided by 60 billion is 33 times earnings. That's too much money. I wouldn't short them because I love Apple. I wouldn't short them because they're unbelievable earnings, powerhouse, powerful company. But I'll wait until they go down to the 200-day moving average. I'm going to wait until at least they're at this blue line before I want to start putting money into them. They will go on sale. They go on sale a lot. So why would I buy them when they're not on sale? Like Levi's, right? And I'm not going to bet on earnings. I have absolutely no clue in the world what's going to happen with earnings. I hope they have bad earnings. I hope they drop like a rock so I can buy them. But I'm not going to guess. That's crazy. You're not supposed to guess. You're supposed to see something. You're supposed to understand something that the market seems to be missing. Like Walgreens is a great price. Like SunPower, I kept saying, was a great price. Like IMAX, with movies coming back around the world, not in the US because we screwed everything up, but IMAX. $11.42. Okay, that's a good price. But it's been down here. It bottomed out at 6. That was stupid, though, obviously. Came back to 9. 11.42. You're constructing a good play to be bullish on this thing. When people start going back to the movies, and they will within a year. Now, I thought originally that people would be back in the movies by July. I didn't know how badly this government would bungle its response to the virus. I had no idea that we would be in no better shape in July than we were in March. because we did this half-ass shutdown in March. On the 15th of March around, we went into shutdown mode, and then by the end of by the end of May, they were reopening, which I was soundly against, if you remember. So we were shut down for half of March, April, and then by the end of May, everybody's like, okay, virus over, let's have holidays, let's everybody go out for the holiday weekend. And then 4th of July, we went out again, blah, 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 and that was the end of it. That was a disaster. Then we had to shut down all summer because it was a disaster. Then it seemed like things were picking up, but then now it's not, because movie chains are shutting down their cinemas because people can't do it. We're in a very bad spot. Too many people have the virus. These guys times 10 or times 5, let's say, so 5 times. So 40-something million people have the virus or have been exposed to the virus, and and we can't, and you can't sit in a movie theater when 5% of the population has a virus. Or I'm sorry, it's 2%. 2% of the population has a virus. There's, I'm going to say there's 300 seats in a movie theater. How many seats in a movie theater? ANC Regal cutting seat capacity in half for all movies. 25 rows with 30 seats. So that's 600. Get out of here. Really? That's a lot. I didn't think it was that many. Okay, so 500. So if you're in it, okay, so if 2% of the people out of 500 are infected, that means there's 10 people infected in a movie theater. There's 25 rows with 30 seats, and 10 of those people are infected. That's why you need social distancing. That's why you need masks. That's why you need protection. When you're in a restaurant, basically, look, 2% is 2%. It's 2 out of 100. 1 out of 50 people is infected everywhere you go. If you're in a supermarket and there's 50 people, 1 of them is infected. If you're somewhere where there's 100 people, 2 of them are infected. That's the problem. But this isn't getting better. It's getting worse. It's obviously getting much worse because we went up 10% in 2 weeks. It's going to go from 1 in 50 to 1 in 25, and that's not better, and that's going to mean it's more dangerous to go out. It's going to be more dangerous to go to restaurants. It's going to be more dangerous to go to movie theaters at the same time as we're being driven indoors by the virus, by the cold, by the winter. And winter time is always a time when we spread germs and bacteria and viruses, because we're in closer contact with each other, because we're not all spread out outside, so on and so forth, not to mention the cold weather has other issues that cause your immune system to have trouble suppressing it. So we got a rough winter ahead, and we got to be very careful. And although the market looks wonderful, hunky-dory right now, we'll just have to see how it plays out. All right. So otherwise, everything's great. But no, it's just about it being cautious. I mean, there's certainly going to be some good things to buy. We just identified in our top trades. We had where are we? So in our top trade alerts recently, we liked EPD, good solid dividend payer. We like I mentioned Bed Bath & Beyond. That's already taken off, but it's too late for that. We liked Pfizer. We liked AT&T. We liked LNG. Not LYG, but LNG. We did pick LNG before it took off like that. And Macy's, how's LNG doing now? Let's see. See, I didn't want to play natural gas, but I wanted to play LNG, who transport the natural gas, and that hasn't really worked out yet, so we'll see what happens. I like Macy's, of course. I always say Macy's, right? Viacom was an old, that's going back to early September now. Viacom, I think, came back a bit. Yeah, see, Viacom starting to come back nicely. Still playable, still good. We started playing down here originally. What else have we been liking? AT&T again. See, just because if it's still cheap, I'll still pick it. Here's Walgreens again, right? There's Walgreens who liked it. Here's China Mobile, still not doing well. No improvement from August. See, in August it was down here, early August, and it's even worse now. Love China Mobile. Here's Intel. We liked them in July when they started falling, or was it before they fell? No, when they fell, we picked them. That's why we picked them, because they, again, patience, right? That's what I'm talking about. Why did I pick Intel? Because it went on sale, because it moved to the bottom of the channel, because I thought that was a mistake. That's why we picked it. Here's AT&T again. That was a webinar when we talked about it. So anyway, so going back to the summary, it's not like we don't find anything to trade, but notice how they're all kind of blue chippy sort of stocks. That's what you want to be in this kind of environment. You don't want to be messing around. So I'm not all doom and gloom. Inflation is actually really good for the market. Okay, the weaker dollar makes it good for the market. I wonder what the dollar did today. Yeah, see, oh, it's not, I can't see from that. So, yesterday the dollar went up because Trump said no stimulus, and that tanked the market. It only went up a half a point too. It's only a half a point rise in the dollar. Went up half a point, tanked the market, and it came right back down again when we start talking about stimulus again. Now it's settling down based on what the Fed is saying. So all these things interacting with each other, and you just have to figure out like what, how to play it. But when you can't figure it out, don't play. Don't force yourself to trade. When something is obvious, we'll see it and we can trade it. But there's no reason to rush into things you're not sure about. And you certainly shouldn't be guessing just because somebody's got earnings. That's gambling. It's fun to gamble. It's fun to spin the wheel and guess what number is going to come up. But that's not how you should be making your investments. Your investment should be coming because something is so cheap that you can't ignore it. That there is no logical reason for Viacom to be this low. That was 15. That's 100% ago, and it's still cheap. This was insane. I was banging the table on that thing every day. I'm having arguments with people about the value of Viacom. I'm like, come on, it's a freaking TV network. So Disney's got problems, but Disney is more people-oriented. Viacom's not. Viacom's a TV show. The TV network. Disney came back hard and strong too. But this is when you buy stuff, when it's totally on sale, when you say, oh my God, it's painful not to buy it. Not here because Disney came from 140 back to 120. That's not when you buy something. You missed it. Move on. Find the thing you didn't miss. What didn't I miss? I didn't miss Viacom. I didn't miss LNG. I didn't miss, well, you missed SunPower. Didn't miss Walgreens. Why not buy the ones that are on sale instead of the ones that aren't? Intel, still on sale. Valero, still on sale. See, we talk about the same stuff a lot, right? Berkshire, Tiffany, I can't tell how far back it is, but these are old webinars that we were doing when we went back. Freeport, that's a good one too. That's one we like when it's low. Talk about Tesla a lot. Macy's. Okay, when I say banging the table, look how I do that. There's Macy's again from some older webinar. IMAX again from an older webinar. We were looking at AMC. I know I didn't pick AMC because the movies are dangerous, huh? They got a lot of problems. Anyway, so moral of the story: got to still be careful. Got to be very selective with our trades and figure out what we want to do. Alan says, there's a storm in the Gulf that will hit the Henry Hub on Friday. I know, but it will or it won't or whatever. It's just late in the season to play that kind of thing. I mean, obviously for a short-term trade, if you want to bet on that, you can bet on it, but you got to catch it before it goes up already. You can't be the last guy to make that bet because you're going to be holding the bag. So how much has natural gas reacted in the last few days is the question. And so look at this huge spike up. So that's could be the contract change. But it's a lot higher than it was, and it may be because of the storm, it may be because of whatever. Obviously the contract rolled over, but the contract only rolls over for a month. So, this may be from the contract rollover and it started up a much higher price, and now it's going to go like this. But when that storm passes, we may start just dropping down again like this contract did. So I don't know if it hits it and you catch it right and it does do some damage or it does shut things down, great. But I would take the money quickly from that sort of thing. But it's really late in the season to have a strong hurricane. But you say category 4. And other than that, natural consumption is low. Yeah, that's what I'm saying. So there's no fundamental underpinning other than you're hoping this storm knocks out production. Would ES at 34.20 still be a short? Yeah, it would on a technical basis, but I wouldn't play against its strength. It's just way too much right now. I mean, this is too strong a move to go betting against. You know, you gotta pick your spots, and this is not the spot where you want to sit there and say, I'm going to short this. I mean, you've got this rising, you know, you're rising up into 34.20. There's all this momentum behind it, and you know, to say that it's going to actually stop dead here. Now, here's what happened though, right? We had this, and we dropped like a rock. So, you know. I mean, if you want to use that line to short, of course, it's obviously usable. And again, we don't know what's going to happen if it starts doing this because we're here now, right? But if tomorrow it goes like that really fast and drops right back below it, then maybe it will be time to short it. But at the moment, you can't bet against green, green, flat, flat, green, green. This is not a good thing to bet against. I'd like to say it's easy, but it's not. It's just, again, when I bet against something, it's because I think the rally is exhausted. So when we're getting up to 34.20, I could see that we're kind of barely getting there. You're having trouble. And that's when I call for a short at 34.20, which is what day is this? October 6th. Oh, this is October 6th. But that's when we call for a short. I mean, obviously I didn't yesterday, but just historically, that's what we do. Well, let's take a wider view of it. So here's 34.20 is right about there. And we thought the rally was too much. But here you go. In fact, last time we called 34.20, went over, then it came back down. Then we had a good short at 34.20. Then we had another one over here at 34.20 on the 16th. That's when we really caught it properly. But we were using that line. Yeah, the line is still valid. It's not going to change. It's still going to be valid for a while. But the momentum isn't going the right way. And you don't really want to bet against that kind of momentum. But when it comes back down, once it goes under 34.20, it's a good bet. And we already know 3600 is a good bet to bet against also. So if we get back up here, it gets interesting. But right here, with momentum going that way, not that exciting to make that short bet. All right. So let's see what else. Blah, blah, blah. And hopefully things are going to calm down a little bit. No, they're not going to calm down. It's the election time, so we're going to cruise into the election. We're going to see what happens, and just got to sit back and just sort of watch it a bit. I mean, let's not get too excited about what happens here. We're going to obviously, this is a great time for us to bump up our short-term portfolio trades. We're probably going to make some adjustments by the end of the week, but let's see what happens. It's a one day up, one day down like this. Is kind of volatility. I don't want to jump on anything until we can get a better view of what's happening. So